Now imagine spotting one cockroach in your kitchen. Because Jamie Dimon, well, he shocked the world yesterday. Now remember, he's the CEO of JP Morgan Chase. He's one of the kings of Wall Street. And yesterday, he whispered the nightmare truth. He said, when you see one cockroach, there's probably more. And he said this on JP Morgan's earnings call on Tuesday. What he was referring to? Well, he's talking about the $170 million hit his bank took from the tricolor bankruptcy that's ready to swarm on your loans, jobs, and even stocks in what's going to be a 2008-like frenzy. And this is something former Fed Chair Janet Yellen claimed we'd never see in our lifetimes. Now, she said that back in 2017. Well, fast forward to today, it's starting to look more likely, as Dimon warns, where you're going to see one cockroach, there's going to be more. Now, he's pointing fingers at the private equity, those private credit villains, but the real infestation, well, it's rotting the cores of America's biggest banks. And this is a concern. This is what he's suggesting, because we can go back just to March of 2023. We saw Silicon Valley Bank collapse. The Fed rate hikes were decimating bond values. Customers were yanking billions, and liquidity, well, it vanished overnight. But what if today, and this is what Dimon's warning about, is the collateral that's sitting on the bank balance sheets is rotten, or worse, maybe even belongs to someone else, as we found out during the tricolor bankruptcy. Now, this isn't isolated drama. It's the classic recession precursor. It always starts at the banks. And the problem is, for consumers and businesses, debts are piling up. And remember, one bug signals hordes. Now buckle up, because the swarm is coming, and I'm going to give you the exact steps, the exact blueprint you need to take to keep these things out of your finances, because what lurks in the shadow is going to crawl and roil every major economy all over the world. Now let's dive in, because what Jamie Dimon was spooked about wasn't just $170 million hit to his bank, but what he was warned about is the fact that there may be more, and a lot more, hidden on every bank's balance sheet. Blue Owl Chief points to bank loads for Dimon cockroach warnings. He said banks might want to look at their own books for cockroaches. Now, he's on the private credit side saying, look, don't point fingers at us, because look, we know your banks are holding a lot of bad debt. The issue here is Dimon either doesn't know, I think he does, or he doesn't want to admit it's on his bank's balance sheet. And the problem is, if it's on his, it's likely on a lot other banks. Now, broadly syndicated investors, asset-backed bondholders, and banks are largely on the hook for losses from both implosions. And this is the issue we're facing, because if there's another financial crisis, guess who's going to take the blame? The banks. And believe me, they don't want that. Now, I've been warning about the shadow banks and the risks they're taking right now. In fact, Dimon narrowed in on some of those risks from non-bank lenders. He said if the economy starts to falter, there could be higher than normal downturn type of credit losses in certain categories. And it makes perfect sense, because the economy's been slowing. Remember that second half rebound we were supposed to experience? Well, clearly it's not happening, but a lot of businesses, they bet big on it. They've got massive amounts of inventory sitting out there, and they need cash. So what are they doing? They're turning to the shadow banks. They're borrowing against the inventory. They're borrowing against receivables. They're borrowing against payables. They're borrowing against anything that anyone will give them a loan for. But here's the real risk. This is what I want you to be thinking about. If that inventory doesn't sell, if those bills don't get paid, what happens to those loans? Then the question becomes is, how long can these businesses continue to make payments on those loans before they enter delinquency and then go into outright default? Because right now, U.S. regional banks face results tests as tariffs trigger uncertainty and growth worries. The uncertainty also casts a cloud on the sector's nascent recovery from a crisis of confidence last year, when exposure to commercial real estate raised concerns about its health. And again, this is something that all regional banks hold a vast majority of. The big banks, they largely don't touch that. So what we're facing is a very real risk here, that a recession will expose the cockroaches. And analysts have warned that a spike in provisions for credit losses, or capital that banks set aside to cover potential defaults by borrowers, this is now expected to rise 28% this quarter. And what this is a sign of is that delinquencies are rising. And we've been talking about that, because as delinquencies go up, there's a fear that these loans go into default. That means banks got to pay. So what happens? They've got to raise their loan loss reserves. And when they do that, that's less money they lend. And of course, as that happens, what you find out, as lending declines, delinquencies rise. The proof? in this chart right here. Let's take a look at commercial industrial lending against the delinquency rate on all loans of consumers at commercial banks. And what do you see very clearly? As commercial industrial lending in blue decelerates and eventually contracts across that horizontal black line, what do you see? Delinquency rate rises. And you can see the relationship each and every time. And the risk right now is we see that commercial industrial lending is already in contraction. So what you're seeing here is a feedback loop, because in a debt-based economy, you need new loans, the creation of new money to pay on old debts. So as you see lending contract or even decelerate, what happens? Delinquency rate is rising here. This is a warning. This is what Jamie Dimon is trying to tell you. He's not just saying it's cockroaches. He's saying, look, there's a recession coming, and a big one. Now I want to take a quick look at this amazing trade we put out to our CTA Timer Pro subscribers yesterday. Now, this is a fully optimized trade. Check this out. We told them to buy on the open KBE at the close of business that day, up 3.71%. Now check this out. Because we've optimized our system on a per security basis over a target 10-day hold period, I've got a lot of data. This is what we told our subscribers, that this trade had an expected win rate of 89% and an expected return of 4%. Making it easy for them to identify amazing trades. And here's the best part: you can join us and start trading right alongside. All you have to do is grab those links in the description below and use a coupon code for your free 30-day trial. Stay tuned to the end of the show for more information. Now, remember that dollar pain trade I've been talking about? Well, for the moment, the dollar bears have stepped in and kept this thing under control. But take a look, because the IMF is warning banks and supervisors of liquidity risk in a $9.6 trillion currency market. And the reason here is global banks have a significant dollar exposure. They're shorted in a big way. And that means they're vulnerable to potential funding shocks. So think about this. When everyone is short the dollar and it rallies, they need to get dollars, and that means they're going to have to sell assets to cover those shorts and get the dollars they need. And what this is leading to is stress in the currency markets that could spill over to other asset classes, tightening financial conditions and posing risk to macro financial stability, which is exactly what I've been warning about. Now, again, for the moment, the dollar bears are holding steady. The question is for how long, because we continue to see signs that the economy is slowing, financial conditions are tightening. And if what Jamie Dimon is worrying about, this is one cockroach, is really a whole lot more, you're going to watch the dollar scream higher as the safety trade comes back in a big way. And when these shorts get squeezed, you're going to see a $9.6 trillion currency market go upside down. Now, this can all be fixed very simply if consumers come out and spend big over the holiday season. But there's a big problem right now, because most U.S. consumers expect higher holiday prices and a weaker economy. In a recent survey, 57% of consumers said they expect the economy to weaken in the year ahead. I want you to compare this back to 2008, which was the worst in the history of this data series. It was only 54%. So what this is indicating is that consumers are expecting they're going to get fewer hours of work. That means they're going to borrow less. And all that means is they have less money to pay their bills. The delinquency rate is going to go up. And that means the cockroaches are going to come out. Let's take a look at this chart of commercial industrial lending versus average weekly hours of production of non-supervisory employees, because I want you to see this very clear relationship that as paychecks decrease, the demand for lending increases. And again, this is across the spectrum. This isn't at the consumer level. This is at the business level. Risk here, again, is consumers are telling us very clearly their hours are likely to go down. What that means, of course, lending is going to stay in further contraction, delinquency rate going to go up. Cockroaches are coming back in a big way. Now, the lower anticipated spending cuts across all household income groups in nearly all generations, and yet it was significantly lower among younger shoppers. Of course, we know they've been struggling in this economy. What we're facing over the holiday season now is spending projected to be 10% less than last year. So now you see these risks I've been talking about. You know, these shadow banks who've been lending money out to businesses who are leveraging everything under the sun. They need a strong holiday season to move all this inventory, because if it doesn't, well, who's going to have the money to pay on these loans? You can see the dollar shortage coming into play. Dollar goes up in value. The cost to service those loans, it goes up as well. And right now, consumers are saying, look, we're not going to come out and spend, meaning, again, delinquency rates set to rise. Shadow banks are going to be in the crosshairs. And again, this is going to roll up all through the banking system, from the small banks, the mid-sized banks, even the big banks like JP Morgan Chase. And this is one of the reasons as we look to the trade war and try to understand why it's so important, because the longer it goes on, the more likely that workers all around the world are going to see their hours get cut. We're going to face further job losses, and the global economy is already heading into a recession and could be in a full-blown recession now within a matter of months. And this is why Treasury Secretary Bissett said, I believe China is open to discussion, and I'm optimistic that this can be de-escalated ultimately. And he knows if it isn't, well, then we've got a problem, because everybody's going down. He says we're confident in the strong relationship between President Trump and President Xi, and we've had substantial communication with the Chinese over the past few days, and we believe there will be more forthcoming in the week. And they better hope so, because right now, as of November 1st, we're scheduled to raise tariffs on China to 130%. You want to talk about putting the nail in the coffin of the global economy? You want to see cockroaches coming out? If that happens, we know it's coming. So you start to understand why Jamie Dimon was warning of what's coming. It's a call to protect yourself. Now, what can you do? You can start to diversify. You can pick up gold or hard assets, some short-term treasury bills, because remember, they follow the Fed's moves, and I'm talking dollars, real ones, not backed by something else. And don't put all of your money in one bank. As far as markets goes, well, it's time to hedge your portfolio. Now, I'm not suggesting you need to go out and buy the VIX or short the market or do anything like that, but maybe it's time to diversify your portfolio, pick up some bonds here. And I'm not talking about those high yield ones that we're looking at blowing out. Again, that's a major red flag. But what you need to do is take a hard look at your portfolio and start to spread your risk out so you can survive another crisis. Because taking these steps will ensure that you have access to cash if things do go wrong, and keep your portfolio intact in case of a meltdown. Because if the economy does melt down, your portfolio doesn't have to go with it. I want to show you that optimized trade we put out to our CTA Timer Pro subscribers again. Again, look at this. In one day, it was up 3.71%. Now, how did we do this? Well, we have a lot of data now because we're fully optimized. We knew that based on our 10-day hold period and our full back test, this trade had a chance of an 89% success rate and had an expected return of over 4% over a 10-day period. Now, what was the difference here? Because I've optimize all of my strategies on a per security basis. This is something nobody else has done. Now, what is our CTA Timer Pro? Well, we take a look at machine positioning each and every day. We try to position our subscribers ahead of big buying and get out before big selling. And we look across the broad equity, bond, currency, commodity markets. But now we took those data points, we ran them through AI, did a full complete back test. We've optimized them and on a 10-day hold period. And we have data that nobody else does, which is giving our traders and you the opportunity to make a ton of money in the markets. Now, what do you get? You get the daily report, you get the tradable signals, you get my opinion on the best trades, you get risk control levels, a full tracking of all open trades and returns, a weekly update, and here's the best part. If you're brand new to trading, or maybe you're signing up for a whole bunch of other trading strategies, you can compare us for 30 days at no charge, and you're gonna see the difference a fully optimized strategy makes. Now, to do that, all you have to do is grab those links in the description below and use a coupon code for your free 30-day trial. And with that, I'm Steve Van Beater. Thanks for watching. Thanks for being fans. Bye now.